Alrighty guys, so in today's module I wanted to talk about the functions of accumulation. I think a lot of people, you've heard of the concept of the power of three. You've probably heard of, accumulation, manipulation, distribution, but there's more functions of accumulation than just that. And my purpose going through this module or this PowerPoint and this presentation is to illustrate these things in action. And the first thing we're going to talk about is accumulation prior to news events. Really important. So again, accumulation can be a key price signature of indecision. When you look at the markets, right, and say price is trading within a really narrow range, obviously what we're doing is we're building liquidity, in this case, on both sides of the market, right? We're generating liquidity on both sides of the market. You can see, right, in this image below, price is stuck to a tight and narrow range prior to the red folder news driver. So again, this here is the tight narrow range. We're building liquidity on the upside and on the downside. Price moves up. This candle here is the news driver, and then what happens? Price moves down. Now, to extend on the function of this particular accumulation, I've seen this play out time and time again, right? More often than not, the side of the accumulation that is left will become a clear target after the news has finished. This is because accumulation pockets can be seen as low resistance liquidity, really important. So we're going to discuss this concept in the following pages. Again, let's get into a little bit more detail. Now this here is on the 5-minute time frame. Let's look at a slightly lower time frame. So this here is the 1-minute time frame. This here is the 5-minute time frame. Again, let's take a closer look. We've got 3 pockets here of accumulation. We've got accumulation pocket A, accumulation pocket B, and accumulation pocket C. So 3 accumulation pockets. Let's take a closer look now at the 1-minute time frame. And again, there's a few sections that I want to look at. First and foremost, I want you guys to have a look at accumulation A. Now, accumulation A on the 1 minute is very, very similar to what we saw here, right, on the 5-minute chart. However, on the 5-minute chart, we don't see anything or any accumulation right before that red folder news driver. If we go down to a 1-minute time frame, have a look here if I zoom in, notice this accumulation here, accumulation B. Really interesting, right? Accumulation isn't just indecision. Yes, it's indecision, but there's a function or a purpose of it, especially when it's placed in key moments in the market or key time frames. So this accumulation is prior to the news event. This is almost just before. It's like probably about 2 to 3 minutes before. We accumulate, we manipulate, and then we distribute. So accumulation A is the indecision in the market hours leading up to the red folder news event. It happens same for NFP, CPI, PPI, same kind of thing can happen. Then price pushes up. We stall again just before that red folder news driver, which by the way, this green wick, this green candle, that's the news driver at 8:30. We accumulate, we manipulate, and then automatically we distribute. So that move up, this abrupt move of that wick, that there can be classed as manipulation. Really important to keep in mind. So accumulation, manipulation, distribution. We've used that accumulation as the power of 3, but we're seeing it right before the news event. That is the key price signature. Moving on to point C, we can see now accumulation on this distribution move. So again, accumulation, manipulation, distribution. In that distribution leg towards this original accumulation in A, we have more accumulation here inside this inversion fair value gap. We're going to talk more about that as we go to the next slide, but it is really, really important. Again, each accumulation offers unique outlooks on price, and it potentially can allow you to see the importance of accumulation in each stage of price movement and delivery. So it's more than just building liquidity. When it's placed during key time frames or before key news events, often but not always, there's a power of 3 set up. So in this case, we accumulate, price pushes up, that tricks traders into going long. You've got breakout traders, right? As soon as price closes or breaks above this point, they're going long. What happens? The market rides them for a little bit. Their stop loss is below this low and below these lows here. Again, any swing high, swing low holds liquidity. In this case, we've got really good liquidity here, or low resistance liquidity. And you can see here that we manipulate up and then we distribute back to the downside. Really important. Now, let's move on to the next slide and actually talk about how this looks in terms of the power of 3. So that's one illustration. Here you can see the power of 3. So accumulation A, accumulation B. Accumulation B is the power of 3. Accumulation, manipulation from the news event, and distribution. It's not random, guys. It's not random that price manipulates, or we have one green candle at 8:30 and then 8:31 is a massive red candle. It's not random. It illustrates the fact that the price will do certain things to manipulate people, and news driver events often are manipulation events, especially if they're red following news. Like, look what happens here. We come up, we come down, we close, right? We close here. Up, down, we close right here. What have we done there? We swept sell side, but we've left this accumulation, and we swept buy side. It makes sense now the market can reprice. You can pair this, right, with other confluences. You can pair this with tapping into a higher time frame PDRA up here, sweeping, external liquidity. You can pair that with those concepts to phrase a high probability setup. Really, really important to keep in mind again. We've talked about that already. Right, so what I want to talk about now is I've marked a few points on this chart, right? So that there is the original accumulation, that's A. You've got this accumulation here, which is B, and then this accumulation here, which is C. Now, that original accumulation, for a lot of people, they're seeing this as the market maker model, which it is, right? Anytime you've got an accumulation pocket and you target that, it could be a market maker buy model or a market maker sell model. In this case, the sell model is complete when price comes down to sweep that sell side. So again, all these concepts, right, can be used as a market maker model. Original accumulation, manipulation to tap into some higher time frame PDRA, and then distribution to tap that original accumulation. So market maker models and the power of three paired with news driver events as manipulation, you're merging these concepts together. Now, looking specifically at this accumulation at pocket C, notice how this accumulation happens, right, inside of this inversion fair value gap. So as I've talked about here, this halting in price, it's actually a good sign. Old going back test, forward test, see price behavior, inside of an inversion fair value gap, and see how we behave after accumulating. Again, we've got a really clear target here. We've got relative equal lows, we've got an accumulation pocket, we've got the market maker model, and what's price do? We stall or we halt just for a brief couple minutes, and then look at how price expands with a massive candle straight down to sweep that, that sell side liquidity. So again, what we notice here is this halting in price action is a great sign. I like to see this personally because I see this as price accumulating more short orders. So again, notice how after this brief accumulation, price aggressively sells off. It's really important. So if you're taking notes, guys, so far we've talked about accumulation just prior to a news event, but it's more than just that. There's multiple pockets of accumulation. There is accumulation inside of an inversion fair value gap. And keep in mind, at point C here, we already have the distribution move in play. So it actually is something that you want to see, and that's what we're talking about down here. Again, this falls in line with the theory of accumulation followed by expansion. Again, most of the time when you accumulate, you expand. Even here, right? Even here, we have accumulation and then we expand. Accumulation, expand, accumulation, expand. When you see these things happen in key zones or key PDRAs, it increases, I guess, the importance of seeing that accumulation. I think that's a really important note. So again, hopefully this opens up your eyes to the importance of accumulation in all stages of price. These events that I've mentioned, then they're often seen around red following news drivers, but it can happen at any other time. And we'll talk more about different time frames in a second. The second point of accumulation here is accumulation as liquidity. And we've obviously talked about this here already, but there's different forms of accumulation liquidity. And again, I like to see it as accumulation pockets. All these accumulation pockets make a great low resistance target. If we apply the principles we already learned, we understand that during periods of accumulation, the market's generating liquidity on both sides of the market, and therefore once one side of liquidity has been swept, the other side is left open. Let's then take that a step further. Use this analogy, right? If one accumulation pocket exists, think there is one singular candle or one singular target, right? So one accumulation pocket equals one target, which equals one magnet. If there are 2 or 3 or 4 accumulation pockets and price is trending in one direction, say for example here, these are just stronger magnets for price to pull to. Again, price will often gravitate or it'll pull towards these key points with greater force. It's really important to keep in mind. Each time price trends in one direction, creating accumulation pockets on the way down, the stronger the liquidity target becomes. Notice how price aggressively trades toward these pockets. And I guess you can think of it like a spring, right? Here's the analogy. We've got an accumulation pocket here, another one here, here, and here. This is like a spring being compressed, 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 compressed after a certain point in time, the spring can no longer be compressed anymore. Once you reach that point during a macro silver bullet, it expands quite aggressively and it pops. That's the exact same principle here, or the same analogy you can apply to the markets when you've got that low resistance liquidity or these accumulation pockets. Yes, it's the market maker model. Like that could be the original accumulation, but these targets, and I encourage you to forward test this, back test this, these targets often, right, get aggressively traded towards. What I've mentioned here, guys, is that if you compare this with a macro or with SMT, it's even higher probability. So this diagram here, these are the accumulation pockets. If we zoom in further, this is the last accumulation pocket. And what I've noted here is SMT. All that means, and this is the chart from the NASDAQ, when the NASDAQ is now making higher lows, we would expect ES, which is a correlated pair, we would expect ES to also make higher lows. If ES is making equal lows or lower lows, that suggests that there's a crack in the correlation, right? One's doing something, the other is not. This is what's referred to obviously as smart money technique or smart money divergence. That divergence in price is really important because it can indicate a smart money reversal. And as we know, these reversals can take place around the macro time frame. The macro time frame I've illustrated with this black line and this black line. So we've got all these accumulation pockets building. Spring getting compressed, press. SMT, macro, pop. Macro runs for liquidity, macro expands, and that's what we see here. Again, the time frames at the bottom, that's 150 to 210, and this is the first macro of the London Open session. So these concepts are really important to consider, guys. It's not just, price is accumulating, it means nothing. Accumulation can be used, and this is another example where I'll talk about accumulation in a particular zone. So we're going to combine all these concepts now with the concept of OTE, which we talked about in previous lectures. So what I want you guys to focus on here, I've drawn out a dealing range from this swing high to this swing low. What I've done is I've marked out the OTE range, which is between 0.618 and 0.786. Inside of that range, here's the important part. I've marked out two accumulation pockets. So in this case, we're going to talk about accumulation being a sign of price halting, and we're going to combine that with accumulation being used as the power of three. The power of three, guys, it's a fractal concept. It can occur in any time frame. Of course, you've got the typical example where the accumulation happens at midnight open, but it's not the only time where it can happen. So what we see with price action here, price moves down. What are we doing? Right, we're accumulating here. And by the way, this is exactly the same example as this. It's the same thing, right? It's the same thing. Price is stepping down. It's the same photo. All we've done now is we've extended this image just a little bit further, right? So price is accumulating. All these pockets here, these are accumulation pockets. So that there is accumulation liquidity. And now we've grabbed a range. Look at what price does in that range. It's not random, right? That price stops between the 0.618 and the 0.786 zone. It's not random. It is algorithmic. Now, looking at price action, I've marked out a dealing range on the chart, and I've denoted the optimal trade entry zone between these two blue lines. First accumulation pocket I want to mention is accumulation pocket A, and I'm going to zoom in and just go across for you guys. Accumulation pocket A. This represents the accumulation for the power of three. So accumulation, manipulation, distribution. Where do we distribute to? Sell side, right? Accumulation, manipulation, distribution. We also have accumulation, manipulation, and as a part of the distribution, we have accumulation here. Why is A and B, or why are A and B working together and not alone? A starts off the power of three. B signifies that price might want to move lower, and we'll go into more detail as we go further. So you just got to consider these things. I've marked out two accumulation pockets. As we talked about, pocket A represents the accumulation phase of the power of three, which we talked about, and pocket B reflects a halting or stopping in price. Pretty much, if you combine all these concepts together, price has retraced to a level of OTE through the use of the power of three, and we've had more accumulation at OTE, stalling, showing that price doesn't want to continue higher anymore. Hopefully that makes sense, right? So we're putting all these concepts together. Again, accumulation, manipulation, distribution, accumulation, manipulation, halting of price. That's what this accumulation functions as. Once we close past this bullish fair value gap, that's our opportunity to go short. Where do we target? Sell side liquidity or any imbalance on this previous price swing. Really, really important. So we can combine these principles to phrase a really, really high probability entry model. Keeping in mind that these key price signatures, we've already discussed these, right? So an entry short can be taken when this inversion fair value gap is created, or price trades back into it here. You consider limit order, but price doesn't have to return to it. So it's up to you how you manage your risk and how you manage that trade. Really important. Where would your stop loss go? Your stop would go above these accumulation highs. When price moves lower, you can probably trail your stop above this candle or above the inversion fair value gap candle. Keep that in mind, really important. Remember, initially there's a bullish fair value gap. It only becomes an inversion fair value gap when price closes below. So despite this, we can anticipate a false support due to the fact that we're in a key level of the previous price swing, being OTE, and we have an accumulation pocket. So let me talk about what I mean there. See this bullish fair value gap here. Initially we use it as support. We're in OTE. So this narrow range of OTE, it has to respect that if we're going low. It has to. Otherwise, what would we be doing here? We'd be taking out this swing high. If we didn't respect OTE, we'd be taking out these swing highs. The fact that we're respecting OTE, the fact that we're accumulating there and then displacing lower, that tells us something. So using a fair value gap as support and then breaking through it is a really good form of an inversion fair value gap, because you're tricking people, you're manipulating people. The more people you can manipulate, often the better the price action will be. Really important to keep in mind. And lastly, I just want to talk about some more examples of accumulation, how it might present. These so far, these are a mix of both the New York AM session and also the London session, but you'll see this in every session. It's not like isolated to those two sessions. You could trade the AM session, PM session, London session, Asian session, doesn't matter. I've now marked out another diagram which we'll talk through, and I want to mark out A, B, and C. Each of these accumulation pockets holds importance. Now, we've talked about accumulation just prior to a news event. Now, a news event happens at a specific time, right? I would encourage you to backtest and forward test this. Accumulation prior, not only to a news event, but prior to 2 a.m., 3 a.m., and 10 a.m. Now, what's important about these times? 2 a.m. is the London Open session, the start of London Open. 3 a.m. is the start of Silver Bullet, when often there's a bit of volatility. And 10 a.m. is the start of the AM session, Silver Bullet. The same might apply at 2 p.m. if you're trading the PM session. Now, not always, but with the right context, this is important. In this case, accumulation pocket A occurs right before the 9:30 open. So 9:30 open is here. We accumulate, and then look what 9:30 open does. We manipulate, we accumulate, we manipulate. Really important. So that's what I've said here. These may include 2 a.m., 3 a.m., 10 a.m., and also 2 p.m. The accumulation prior to the open times can often be used with the concept of the power of 3. In the example below, accumulation A is followed by an abrupt manipulation move down, which is then followed by another accumulation and manipulation move labeled B. Really, really important. So accumulation, manipulation, accumulation, manipulation. If we then entered a macro, if we then entered Silver Bullet, if we then had SMT at the lows, then we can predict a smart money reversal. Then we can combine this concept saying, wait a sec, we've also inversed this bearish fair value gap, we've inversed that here. Wait a sec, we've now got accumulation pockets to target, we've got low resistance liquidity, and wait a sec, when we've moved up, look at our price uses this previous bearish fair value gap and find support there. And that's what we're mentioning here, guys. Look, part C, and look at the chart, right? We've got this really fine price signature here, which is a bearish fair value gap. Price moves up and then we stall. So in terms of stalling, it's all contextual. Are we in OT of the previous range? Do we have, in this case, an opening range high? Do we still have accumulation to target, right? Do we have a news candle above the target? So for example here, if price wanted to move up, we could. If there's a news candle, these news weeks make really good liquidity targets. And that's what we're talking about here, guys. So again, price comes down, we have the smart money reversal at the bottom, pushes up, stops and halts in what's called a balanced price range. All that is, as we've talked about, it's a bearish gap that overlaps with a bullish gap. It's not random that price accumulates there. It's not random. So we've talked about that here. So notice that the bearish gap on the left side of the curve, that's the left side of the curve, and how it perfectly and completely overlaps the right-hand side of the curve. Left-hand side, right-hand side. Again, the accumulation here, which is at point C, occurs for multiple minutes, indicating an unwillingness for price to continue lower. The fact that the BPR is created perfectly with such a small sell side imbalance, like that is such a small imbalance. The fact that we create that perfectly and mirror that on the other side and accumulate there, that says something to me, right? This is an algorithmic price signature that should be trusted and has high probability to move higher. Really important, right? Really important. The more precise the price signature, often the more important it is to consider. Now you can use this concept with other concepts too, guys. This here is on the 1 minute time frame. By all means, you could zoom in to a smaller time frame. If you trade the 30 second, the 15 second, you could look for the things you talked about. You could look for a sweep liquidity. You could look for a change in the state of delivery. You could look for a market structure shift and then phrase a trade higher based on that. If not, it just becomes something that you should want to see in these zones. So for example, say in this example here, if we had a balanced price range created here and we dug back down and then accumulated, that's good. That's a really good thing. And then expand it up, that's really, really good, right? Same thing here. So accumulation is more than just generating liquidity on both sides of the market. Yes, that is the base function, but you've got to see accumulation in different times, before different times, and in key zones, and look to see how price accumulates in different PD ranges. So again, I hope you guys got something from this video, and until next time, I'll talk to you then. Peace.